Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about mortgage rates. Yesterday's video, we talked about home prices and how we're up year over year. If you didn't see that video, I'm going to put it right here. You just click on that, and then it'll play as soon as this video is over. So year over year, home prices are up year over year. Exact date to exact date, which is not something people expected, but this is another thing that's sort of unexpected. This is a Realtor.com article. Mortgage rates just dropped, but will they stay down for long? A look ahead. Now, mortgage rates are not perfectly tied with the Fed, right? The Fed doesn't raise rates and then exactly everything snaps up a quarter or half a point.
No, so here's kind of the way to think of mortgage rates. Mortgage rates are more forward-looking, and the Fed rate is more backward-looking. And what I mean by that is that the Fed is reacting to the past, and the mortgage rates are anticipating the future.
Yeah, like the way the stock market does, it's just like when you're in the middle of the recession, things are bad, that's when the stock market turns around. Because it says, hey, the worst is past us, we're now going to get out of this. Mortgage rates do the same thing. Remember, they're market driven. They're more closely tied to the 10-year note than they are to anything else. And which is another whole nother video why it's not the 30-year. It's not the 30-year, it's the 10-year because people don't actually hold a 30-year mortgage 30 years. Anyway, we'll talk about that.
So it'll be interesting to see, actually, just a side note, it'll be interesting to see as people are holding their homes longer, if that's going to change, whether it's still going to be tied to 10-year or to something else.
Yeah, and that's true, but keep this in mind. Since last November, the Fed has raised interest rates over 1%, but yet mortgage rates are less than they were back in November. So the Fed has been raising rates, and mortgage rates are actually down. So this thing of, oh, well, the Fed's going to raise rates again, that'll make mortgage rates go up. No, it doesn't work that way. But here's the first the first quote from the article. But there's some joy in the market as of late. In the week ending July 20th, mortgage rates fell to 6.78% for a 30-year fixed rate loan, according to Freddie Mac. That's a welcome relief given last week's rates hit their highest percentage, which was 6.96 since November. So it's down about 0.2% in a week.
Yeah.
So, we know that when we...
Yeah, what I was going to say is 0.2% may not seem that much, but, over time, it adds up.
Another thing, too, is, remember, people are anticipating this a little bit because, we had where mortgage rates ticked up a little bit, and then a lot of people were saying, hey, this is what crashes the market, mortgage rates going up. And then inventory kept going down. And then we had 1 week where the interest rate dropped a little bit, just like this, and then we had a spike of homes go under contract. And so we're going to tomorrow do an update to the Las Vegas market. We'll grab that data and see what's going on. Right now, what's happening in the real estate market is opposite what we normally expect to happen. Normally, prices are starting to decline, inventory's going up, and the opposite of those two are happening, and interest rate is affecting that to some extent.
Right.
Okay. So the next quote from the article, yet while prices are declining, it's not by much. Now, this is not this year month over month declines because the whole country and places like Vegas, home prices have been going up every month. But this is the year over year comparison. The median asking price for a home has fallen less than 1% since June 2022's all-time high of $449 and was stuck at $445 in June. So June year over year was down less than 1%, but July year over year is actually up. That was yesterday's video, the one that I put in there, right, Juana? That year over year prices are up nationwide, not in every market.
Right. So, whether you're looking at June or July, basically we're either dead even or slightly higher. Now, this doesn't apply necessarily to everybody watching because remember, real estate is hyper-local, so it could be different in your market, but these are national numbers.
Juana, what do you think about the strategy that people have been talking about where, there's so little inventory that if you find a house you really want, even if it stretches affordability, buy the house, and then in 12 or 18 months, interest rates get back to 4.5 or something. We're not saying they'll go back to 2, but 4.5. Just do a refi.
Right.
Because what is the risk if they, and we're not saying to buy now, so don't try to pin that on us, but let's say somebody waits a year from now to go buy a house, and then interest rates are 4.5%. What's the market going to be like?
Insane. There's so much pent-up demand. There's pent-up demand both on the seller side and the buyer side. So there's going to be a frenzy of activity on both sides once interest rates look like they're going to consistently head south. I don't think people are going to wait until interest rates get to 4.5. I think people are going to take action way before then. I think people are at a point where if they find the right house, they're going to move heaven and earth to get it because they understand two things. One, inventory is scarce, and two, interest rates are not forever. Now, we've done a video regarding refinancing, and there are things to consider regarding making that your plan of marry the house and date the interest rate. There are pitfalls to that. So if Todd wants, he'll put up that video for you. Are you going to do it?
Yeah, I'll put that one right here. We made it a few days ago.
All right.
That talks about refinancing.
Right. So there are some pitfalls, but at the end of the day, if this is the right time for you in your life, in your financial situation, to buy a house, and you find the right one, that this may be the time to do it and deal with the interest rate at a later time.
Okay, so here's another quote from the article, because you mentioned inventory. Mm-hmm. Meanwhile, the number of new sellers entering the market has been shrinking for 54 weeks straight, largely because many sellers might be reluctant to give up their current low interest rate mortgage if they move. We were told by the crash bros and the housing doomers that the interest rates, people would flood the market to sell their house to capture the top of the market. It's like day trading houses, right? And then their interest rates, there would be no buyers, and this would finally crash the housing market. And it literally didn't happen. And as a matter of fact, inventory's been on a decline. We're at 54 weeks where the number of new sellers entering is less than the previous same week of number of new listings coming on the market. Talk about that, Juana.
Right. So that's exactly what I was talking about, is that inventory is really scarce. And it really doesn't look like it's going to pick up anytime soon. And even when it does pick up, anything good is going to get snapped up because people have been waiting for so long to buy a house. Now, I understand affordability is an issue, but it is not an issue for everyone. And it is certainly not an issue at every price point. In most price points, the issue is lack of suitable inventory. So this whole thing with the inventory being down, that's a substantial issue, and that's the thing that's supporting real estate prices, and that's the thing that's going to continue to drive real estate prices up, because a good product is going to solicit a lot of interest, and people will be willing to pay over appraised value. We see this every day.
Also, something to keep in mind, we do not question affordability is historically pretty bad right now because interest rates are high. That's the only, look, the unemployment rate is the lowest it's been in 50 years. Mm-hmm. The number of people who are behind on their mortgage is the lowest it's been in 50 years. Wage growth is the highest it's been in decades. Mm-hmm. People's wages going up. Home prices are up quite a bit. That's hurting. But interest rates are up, and remember, interest rates are temporary. Interest rates tend to bounce around. Mm-hmm. We understand that is a problem. But I will say this. The inventory is so low that the people getting the homes, your typical person that you would think is going to be a buyer, which is somebody who they make $40,000 a year, and they're going to put not as little down as possible, and it's all going to be a big mortgage payment for them. They can't afford. They're not the people out there. 30-something% of all homes are purchased with cash.
Right.
The other 65%, 90% of those are putting over 10% down. So if you show up to your house like we did, we've been talking about this, trying to buy a house, another house, investment house, second home, whatever. And when you're putting 20% down and they're saying, hey, we're going to reject your full price offer at 20% down because somebody just offered us cash.
Right. And they offered cash at full price. So it's not like the cash buyers are getting discounts. We are seeing that cash buyers are having to pay full price just like everybody else. We're seeing that finance buyers are having to pay full price and meet the difference between the purchase price and appraised value if the appraised value is lower than the agreed upon purchase price. So that means that, for example, if you are buying a home for, let's say, $1 million and it appraises for, let's say, $875,000, you're willing to pay that $125,000 difference to meet that difference, even though you're getting financing. So that means that not only are you putting your 20% down, but now you're coming up with another $125,000 on top of that to meet that difference. So, I gave the example of $1 million because it's easy math, but this is not uncommon at all kinds of price points. Where it is less common is actually in the lowest price points, because those tend to be, if they're not investors buying cash, if they're people using financing, they tend to be people who are putting less money down. And so those are the ones that don't see as much of that. But once you get into, I would say, somewhere around between 500,000 and 700,000 here in Las Vegas, then you're seeing a lot more of that. And certainly once you get above that, then absolutely, sellers are just not willing to sell for less than their list price. If you look at our numbers overall in our marketplace, sellers are selling for over 97% of list price. So that lets you know that people are getting full price for the most part.
Okay, my prediction.
Yes.
1 year from now. Right now, interest rates are about 6.7%, right?
Okay.
5.5 a year from now. 1.2% less.
I'll go with that.
That's a prediction.
Yeah, I'll agree with that.
So now, I'm not saying that's going to happen. Nobody knows. If I was buying a house right now and I found the right house, I would just buy it.
Right.
And then I would deal with a year of the payments, and then in a year I would just do a refi, because I'd rather refi in a year than come back in the market in a year and try to compete with everybody else, get bid up on the price of the house, or maybe not get the house I want and have to settle for some other house. That's what I would personally do.
Right. So now remember, this doesn't apply to every market. We're just giving an example of what's happening here. This article is talking about nationally. We are aware of other markets that they're seeing some softness in their prices. For example, I was looking in San Diego, and they're getting some price reductions.
Okay.
And so, I don't know how prevalent their price reductions are, but I just kind of skimmed it a little bit. And there were quite a few price reductions. So I don't know if they came on the market with optimistic pricing.
A one-bedroom condo, they reduced the price from $1.5 million to $1.4 million.
Right. So, look, but the point is that they are getting some price reductions.
Yeah.
So it'll be interesting to see kind of what happens. But this is kind of the thing that we normally expect in the market, right? This time of year, we expect longer days on the market. We expect some softness in the prices, because we're going. I know it's hot everywhere. It was crazy hot today here in Vegas, but we are expecting some softness in the market as we go into the fall, and we don't pick up again until the end of the year. But
for now, it's not happening.
No,
we're not seeing it.
No,
the opposite's happening, which is surprising me, because I thought a month ago we would go into our normal cooling, but the market's still sort of screaming, and I'm not sure why. I think it's just pent-up demand.
Well, I think it's pent-up demand and lack of inventory. Again, supply and demand, right?
Yeah.
I think that's really the big thing. So, do we have any more slides?
No.
Okay, well then tell us.
Underachiever today. I didn't have any. There were no charts or graphs or anything fun.
I know it. Okay, so feel free to request more charts and graphs in the comments.
Tomorrow's video, we're going to have like 6 of them. They'll be really good ones.
Okay.
This is a real estate update.
Okay.
So you got to subscribe if you want to, and notification if you want to make sure you don't miss that one.
All right. So please feel free to leave us comments. We enjoy your comments, and we enjoy engaging with you. Please subscribe, hit the notification bell, like the video, share the video, leave us love notes, be nice to one another in the comments, and we'll see you on the next video. Bye.
Bye.